Hi, welcome back everyone. I'm Mehmet Pirzada and this video is part of the MSc unit on International Finance and Economics at the University of Bristol. So in this video, we are going to use the framework we developed in the previous video to ask the question, how is it that the central banks conduct monetary policy? How is it that they affect the money creation process, which then goes on to affect the aggregate demand in the economy? So let's start from the old view. By old view, I mean, how is it that the central banks used to conduct monetary policy back in the 80s? So what they used to do in the 80s was they would directly control or affect the money supply. So this is something you've also heard in any economics course you have taken as well. So that the central bank increases the money supply or decreases the money supply. So this is really coming from the 80s way of doing monetary policy. This will then go on to affect the interest rate in the economy, which then goes on to affect how much agents in the economy, households and firms are going to borrow, which then affects the aggregate demand as well. So let's have a look at how this works or how this used to work. And then I'll also highlight what was the problem with this and then why is it that the central banks then moved on from 90s onward. And rather than targeting money, which then affects the interest rate, now the central bank targets the interest rate, which then affects aggregate demand, which then affects money supply and so on. Right? So it's almost the total reverse of how things used to work in the 80s. So let's start from the balance sheet of the banking system. The key thing to note over here is we'll assume that the banking system, they need to keep an equivalent of 10%. So this is an arbitrary number. It could be 5%, 20%, whatever. So we'll assume it's 10%. That the banking system has to keep an equivalent of 10% of their deposit base in the form of reserves, current cash or reserves, right? Why? Because we say or we assume that this is the amount they'll need in order to meet the liquidity needs of their customer base. If they keep any less than that, then they won't have enough cash and reserve balances to meet the liquidity needs of their customers. And what that means is that there is a likelihood or a higher or an increase in the likelihood of there being a bank run. And that's something they don't want. Right? So in our scenario here, in our benchmark here, they have just enough reserves to meet the liquidity needs of their deposit base. What does that mean? What that means is that at this point in time, the banks, they can no longer lend, or the banking system as a whole, it cannot go on to issue new loans. Because if it goes on to issue new loans, that will then create new deposits, and then you'll need more in your reserves, or you need more in cash and reserve balances in order to meet the liquidity requirements of the new deposit base you have created. But we can see over here that the banking system does not have enough of those, enough of cash and reserves to meet the liquidity requirements of those, of any extra deposit base they want to create. So how does it work then? The way it works is, now in this system, the central bank intervenes directly. The central bank says if the central bank wants to increase aggregate demand in the economy, wants to stimulate the economy, the central bank will intervene. The central bank will buy securities worth 10 from the banking system. And in exchange, the central bank is going to credit their reserve account by the same amount. So I'm abstracting from interest rates and so on. So just to make life easier, right? So this is what they are going to do. Now you can see, now the banking system does have excess reserves, and now they can go on to issue new loans and create new deposits. So so fine, they do want to issue new loans now, but why will more people want to borrow all of a sudden? That's a question which should be understood as well. Fine, if banks are willing to lend more, if the economy is in equilibrium before and the banks all of a sudden are willing to lend more, why will more people want to borrow? So the way, and therefore, if more people are not willing to borrow, then how will aggregate demand increase? And how will this stimulate the economy? So the way it works is, now all of a sudden, banks want to issue new loans. So what happens is that the supply of new loans increases. So now the supply of new loans is greater than the demand for new loans. And if the supply of new loans is greater than the demand for new loans, what that means is that the price of new loans is going to go down. In other words, the cost of borrowing is going to go down. So interest rates are, or the lending rates are going to go down. So as interest rates start going down, the demand will start increasing, and interest rates will keep on decreasing until the point where the supply of new loans is once again equal to the demand for new loans. So as interest rates decrease, now firms and households have more of an incentive to borrow more. And because they'll borrow more, and this will keep on happening, interest rates will keep on decreasing until the point where the market is once again in equilibrium, right? Or you can say the loan market is once again in equilibrium. And in this process, you can see new loans or new money supply has been created worth 110. And that 110 is made up of bank money, which is 100, and the base money, which is 10. And this has then stimulated aggregate demand in the economy. This has then increased, stimulated the real economy, the GDP, through consumption, investment, and so on. So this is really how the central banks used to conduct monetary policy back in the 80s. So just to recall what I've just said, so the central banks will increase the base money supply. Now, because banks have more liquidity than before, they'll want to issue new loans. But just because banks want to issue new loans does not mean that people want to borrow as well. So what that will really do is, because banks want to issue new loans, supply of new loans is greater than the demand for new loans. So the price of new loans is going to go down. In other words, interest rates are going to go down. As interest rates go down, demand for new loans will keep on increasing. And this will keep on happening until the market has cleared, until the demand for new loans is equal to the supply for new loans. Right? And this is what we see happening over here, where in equilibrium, essentially you end up issuing loans worth 100, which ends up creating or increasing the aggregate demand, and therefore ends up stimulating the economy. Now you can also see there's a problem with this. The problem is that the economy is already or always hit by different shocks. Sometimes banks want to borrow more, lend more. Sometimes they want to lend less. Sometimes people want to borrow more, borrow less, right? So let's say if all of a sudden COVID happens, banks don't want to lend more because the risk of default goes up. Or let's say households want to borrow or firms want to borrow more because let's say their cash flow dries out and so on. So what does that mean? These changes in demand and supply for new loans almost all of the time in the economy mean that the price of these loans or the interest rate will keep on fluctuating. It will keep on either increasing or decreasing in order to make sure that the loan market remains in equilibrium. But this is not good. Why? Because interest rate is really the key instrument which determines, or the key variable which determines how much firms want to borrow or will want to borrow, or households. It's the cost of borrowing, right? And if the cost of borrowing keeps on fluctuating, if it's very uncertain, then it's very hard for firms to figure out the net present value of any investment they want to undertake, and therefore it makes them much more risk averse. Right? Rather, they are risk averse, and because there's this uncertainty now about the cost of borrowing, and therefore net present value of any investment project is very uncertain, so they are less likely to invest. Likewise, households are also less likely to borrow because of this uncertainty, and because households are generally risk averse. And this makes it very difficult for the central banks to conduct monetary policy, because if the interest rate, if the price is so uncertain, then essentially the investment decisions and the consumption decisions will also get affected, and the monetary policy will not be able to manage business cycles as effectively as otherwise, or the monetary policy will not be as effective in stimulating the economy or controlling the economy when the economy is in boom. And this volatility in the interest rate essentially, and the difficulty which comes with it in terms of managing business cycle fluctuations, that became the reason, or the primary reason, for why the central banks ended up moving away from conducting monetary policy by explicitly controlling money supply. Instead, they then moved on to the exact opposite, that now they ended up controlling the interest rate, the short-term interest rate. It's important for later, remember that. So the central bank controls the short-term interest rate, which then affects households' demand or firms' demand to borrow more, which then affects how much money is going to get created in the process. So let's have a look at that. Let's say that the central bank decides to decrease the interest rate from wherever it is. And let's start from the same starting point as before. So we have just enough reserves to meet the liquidity requirements of our deposit base. Now, this decrease in interest rate is going to create a demand for new loans of, let's say, £200. So remember, loans do not just get created because of demand or because of supply. It's both the interaction of the demand and supply factors which determines how much of new loans will get created in the equilibrium. Right? This is what we looked at in the last video. So let's say there's demand worth of £200. Banks look at the application and they decide they only want to issue new loans worth 100 at this interest rate. And the market ends up clearing, and they end up issuing new loans worth 100, which ends up creating new deposit base worth 100 as well. Now, remember, these are arbitrary numbers. These are just there to show you what's happening, right? The banks may end up deciding that they want to issue more loans or less loans. So this 100 is just totally there to show you what's happening. It doesn't really have to be 100. But now also note, in this process, even though they have issued new loan and created the new deposit base, they don't have enough liquidity in the system to support the liquidity requirements of their new deposit base. So what is going to happen? So what is going to happen is very simple. The central bank is going to step in and say, okay, whatever liquidity you need in order to make sure that the equilibrium is achieved or is sustained at the level of the interest rate they have already set, they'll intervene and they'll make sure that they provide that liquidity to the banking system. Because if they don't provide that liquidity, then banks won't be able to issue these new loans and create new deposits, which then essentially means that the market will not be able to clear at the interest rate which the central bank has set. So in order to make sure that the loan market clears at the interest rate which the central bank has set, the central bank will have to end up providing the liquidity which the banking sector needs for that equilibrium, for the interest rate to stay where the central bank is actually, or where the central bank wants it to stay. So the central bank is going to step in and say, okay, fine, you have created new loans worth 100. You need additional liquidity worth 10% of 100. So again, I'm going to step in, I'm going to buy securities worth 10 and credit your reserve account by the same amount. And this is it, right? This is how the central bank, this is how the monetary policy is actually conducted in the modern economy from 90s onwards. Right? So in this case, now you can see what the central bank really cares about is the interest rate. Why? Because it is the interest rate, the increase or a decrease in interest rate, which determines how much households are going to, or which is an important factor, one of the important factors which determines how much households are going to borrow more or borrow less, and likewise for firms. And therefore, that's going to then affect the aggregate demand and stimulate the economy. Right? And in the process, the money supply gets created or gets destroyed automatically, just to make sure, in order to be consistent with the equilibrium where the interest rate set by the central bank is sustainable. But what happens when the economy is at the zero lower bound? Then in that case, remember I said that the central bank controls the short-term interest rate. And by that, I mean, you can think of that as one period interest rate. What happens when that interest rate cannot go below a certain threshold? For the sake of this session, let's assume that threshold is 0. It could be minus, but there is a certain threshold and you can't go below that. That could be 0, could be -1 or whatever. Let's assume it's 0 for this session. How will the central bank stimulate the economy at that point? And in order to understand that, we need to understand the term structure of interest rate. Now let's look at this. What is this? What is the term structure of interest rate? So before we make sense of the equation, let's look at this variable here. This is INT, and this is essentially the interest rate at time t um, on an n period bond. So let's say n is 5 here. So what you're saying is, what is the interest rate on a 5-year bond at time t? So this is what that is. So this is another way, or you can think of 5 as a long-term government bond, right? Or a long-term bond. So n could be 5, n could be 10, n could take any number you want to give it to it, right? So I5t, for example, here will be the interest rate at time t on a 5-year bond. I1t, it's an interest rate at time t on a 1-period bond. So this I'll call as the short-term interest rate. So on a 1-period bond, the interest rate on that at time t, that's the short-term interest rate. And now you can see over here, this is an expression, this is I1, so it's the short-term interest rate at time t plus k. And k could be any number from 0 to n. So it's essentially saying that the long-term interest rate here, or the interest rate on an n-period bond, the interest rate at time t on an n-period bond is actually a geometric average of the expected short-term interest rates over the relevant duration. It's the expected value, it's the geometric average of the short-term interest rate today, tomorrow, the day after, until all the way till n. Okay. Plus the term premium. Okay. So in short, the long-term borrowing costs, or the interest rate on a long-term government bond or on a long-term asset, that could be government or private, that is equal to the average of expected short-term borrowing costs over the relevant time period, plus the term premium. And the term premium is made up of risk premium, inflation premium, and liquidity premium. So if you expect inflation to be higher moving forward in time, then you'll demand a higher interest rate if you are lending money to someone for n periods. Or if you think the other person, the probability that the other person will default is much higher, so you'll demand a higher interest rate from that person whenever you're lending money for an n period. Or if you need the money for other purposes, let's say you need to make payments and for your businesses, for otherwise, or let's say it's a crisis, so you don't know, you might lose your job and you want to keep the money with you. So the liquidity premium is much higher. So in that case, again, you'll demand a much higher interest rate when you are lending money to someone for n periods. Okay, so this is what the term structure of interest rate is. Now the key thing over here is that what the central bank normally does in normal time periods here, when by normal time period I mean when the interest rate or the short-term interest rate is not equal to 0, it's not at the 0 lower bound. What the central bank does is the central bank simply controls the short-term interest rate, either increases it or decreases it. And then that goes on to affect the long-term interest rate as well. Or by controlling short-term borrowing costs, the central bank is able to influence long-term borrowing costs. And then the long-term borrowing costs then matter for investment decisions or consumption decisions. Right? The only thing which I need, which is left to explain now, is how does the central bank control the short-term borrowing cost? The way the central bank controls the short-term borrowing cost is by buying and selling short-term government bonds. So if the central bank wants to decrease the interest rate, what the central bank will do is central bank will buy more of short-term government bonds, which will then increase the price of short-term government bonds, which will then decrease the interest rate on the short-term government bond. And by decreasing the interest rate on a short-term government bond, in other words, by decreasing the short-term interest rate here at time t, it can go up till k. So if the central bank says they will keep the interest rate low for the next 5 periods, so then the short-term interest rate will remain low for the next 5 periods, and that will go on to influence the long-term borrowing costs much more. And that will then stimulate the economy. Okay. But what happens when the economy is at the zero lower bound? What happens when the central bank can no longer decrease the short-term borrowing cost because they are already at the lower bound? You can't. You can buy more short-term government bonds, but that will not lower the interest rate on short-term government bonds below a certain threshold. In our example, 0. So what does the central bank do? The central bank does a very simple thing. There's nothing new there. What the central bank does is, and this is normally referred to as unconventional policy, what the central bank does is that now, because buying short-term government bonds is not going to help lower the short-term interest rate, and therefore it's not going to help to lower the long-term borrowing cost, so the central bank is going to directly buy the long-term government bonds, or more recently, even corporate bonds. So, and the mechanism is very simple. So the central bank buys long-term government bonds. That increases the price of long-term government bonds, and therefore that decreases the interest rate on long-term government bonds. So you should know that there's this inverse relationship between the price of asset and the interest on that asset, right? So you should know this from your finance courses. So that's all, and that's all what QE is about. Or essentially, that's an important part of what the QE is really about. So by buying long-term bonds, private or government, in most cases government, the central bank ends up influencing the price of these long-term assets, and therefore ends up influencing the interest rate on these long-term assets, or in other words, ends up influencing the long-term borrowing cost. And that's all what the unconventional, that's an important part of what an unconventional monetary policy is, what a QE is. Now, the next thing you should be thinking about and should be asking is, does it work? Now, there are two parts to it. One is, does it work in lowering the long-term borrowing costs or not? And then there's a second part to it. Does that, like, do lower borrowing costs, do lower long-term borrowing costs, do they end up stimulating the economy or not? Right? Do they end up incentivizing businesses to borrow more and invest more, and therefore increase aggregate demand in the economy or not? And the answer to these two different parts of this thread, the answers are very different. So for the first one, the answer is definitely yes. So here's a table which is a compilation of different studies which have studied how QE, or buying long-term government bonds, in this case 10-year government bonds, how that affects the yield or the interest rate on these long-term government bonds. And I've taken this table from this paper, this 2016 paper. And it turns out in almost all the studies, yes, indeed, the long-term borrowing costs do go down. They do fall. In some studies, the effect is much bigger here. In others, it's in few others, it's pretty low, 15 basis point, 26 basis point. But generally speaking, if you take the average of it, it does look like it's somewhat less than 1 or 100 basis point, but it's still higher than, let's say, 70 basis point. So the effect is rather quite significant, given that the long-term interest rates are pretty low in advanced economies to start with. So a 70 basis point reduction in that is quite significant. But whether this has an effect on the economy, whether this incentivizes households or businesses to borrow more and consume more, and therefore stimulate aggregate demand and pull the economy out of the recession, the evidence for that is not very obvious. If you ask the central banks, they'll say it works. It does have an effect. If you ask some other people working in universities, academics, they'll probably be a bit more skeptic. Okay? So there's no consensus as such at this point in time, which supports either of the claim. Maybe it works, maybe it doesn't work. Maybe over time we'll end up developing better methodologies and be able to figure out a more precise answer to this question. But it's important to differentiate the two steps over here. The first one, whether it does help in lowering long-term borrowing costs, yes, it does. Whether that has an effect on the economy, at this point in time, we are not certain. There's some evidence it has, but there's also other which says it does not have much of an effect. And with this, I say thank you. So I think by now we have already figured out how the banking system works, what is the role of banks in creating or in the money creation process, why are they important in the allocation of resources in the economy. And in today's session, we have also looked at how do central banks intervene in the banking system, or what is the role they play in the whole financial system in order to stimulate aggregate demand, or you can do the opposite of this, which is contain or limit aggregate demand. Um, and in the next session, we are going to move on and look at the financial crisis, the 2008 financial crisis, and see why it happened and what is the role central banks played in order to contain or limit the effect of the financial crisis on the economy. So take care, and I'll see you in the next session. Bye-bye.